All right, everyone. Welcome to today's event where we are going to be talking about the rise of angel LP syndicates. And we're picking the brains, unfortunately, not of a panel with 300 plus startup investments, but probably more something in the neighborhood of 200. And that's because I was hoping that we would have a great, awesome angel that I unfortunately had to let go for other business purposes today. I'm very sorry. I promise I will bring him back for another session. Today, we will go for an agenda that says intros, meaning you want to know everyone who's here on the call. Of course, you should be allowed to. Then we'll go into LP investing and the role of syndicates. We'll only do a very short 5-minute presentation, at least no more than 5 slides. I think we'll be able to make it through very, very quickly. And after that, we'll dive into the big Q&A on how to think about picking VCs, how to get the most out of working with VCs as an LP, and how to help VCs. I am just now checking if everything is live. Guys, can you see it? Would you check for me?
Yeah, it's live.
It's live, cool, because I'm looking at it at the same time on my right-hand side, and I'm seeing it not live. So that's why I'm asking. All right, everyone, I will just ask you or tell everyone in the audience first. Here, as you see, we've got Michael, who is a master venture capitalist. We've got Mark, also Mr. Venture Capitalist. And then we have Joachim, who's also a Mr. Venture Capitalist. And then we've got David, who is a syndicate lead. And we've got me, who's the hype man and the guy who will try and orchestrate and get us through all of this. But we do actually have a little more breadth of opinion here because these guys are more than just VCs. Michael Sitchmore is a VC and also FO type thing, and also a very active angel and has been for many years. You see the same thing on Mark's face. We've got VC, fund builder, and angel, and then we've got VC and FO and angel on Joachim's face. So let me just kill this little presentation and then ask Michael to share a bit about himself and your background and how you've gone into venture and what experience you have with investing into venture funds.
Hey, everyone. Great to be here. My career in venture really started on the corporate side. So I started at Goldman Sachs in London, investing into fintech companies. There was a team that invested balance sheet capital from Goldman into capital markets related businesses. So I saw the corporate side of venture and got very lucky that I ended up in the fintech space in 2012, 2013, just as many of the companies that we now know today, the Coinbases, Robinhoods, et cetera, of the world, were starting to take hold in the fintech space. Then went to the operating side. So was called by a company called Mosaic, a solar finance business out in California. And I was the first sales hire there. I was number 16, built the investor network. So I've also seen investing from the LP side in a few different ways. So I built the high net worth community at Mosaic. It was not venture investing. It was fixed income solar products. So grew the platform to about 11 billion of home solar loan originations backed by Warburg Pincus, one of the two large players in the space in the US. Then moved to New York, built the investor network pre-product at a company called iCapital, which has really enabled the high net worth community now globally, starting in the US, to access high quality private equity funds, hedge funds at lower minimums. So again, have the perspective of selling funds to the high net worth community. That was the big buyout funds like the Warburg Pincuses, the Silver Lakes, et cetera of the world, but built the investor network there. That's grown to about 153 billion or so of assets, profitable fintech unicorn at this point. Backed by many of the banks, Blackstone, BlackRock, et cetera. And then met my partner, who was a successful entrepreneur himself, sold his business for a few $1 billion, and then built a fintech investment bank that now has about 75 people here in New York and Chicago. And we decided to build a venture fund called Broadhaven Ventures. We're a little bit different in that, as Andreas said, we invest principal capital, so it's off our balance sheet, as well as the partners from the bank are investing alongside of us into fintech companies globally. And we're leveraging the platform that we have, done about 90 billion or so of M&A transaction volume on the banking side. So we can help fintech companies from seed all the way to IPO or exit. And we invest directly. We also invest into funds as well. So we have a portfolio of funds outside of fintech to get exposure to other geographies or sectors So we have a portfolio of 18 funds at this point. And then we also build and incubate asset management businesses. Currently incubating a business in the asset management space, a GP staking business with one of our partners, who is a partner at Goldman, in collaboration with a large bank in Latin America to do minority GP staking a little bit further down market from Dial. So kind of see the investing landscape on the LP side from a number of different ways, and really just think of fund managers as founders. So want to help them build their business in various ways, and love what you all are doing at EUVC as well, because you're helping them build their business too.
Yeah, exactly. And on that note, I will go to Mark, I think, because Mark, you are also a bit in your past life a fund builder. You have a great experience in that. So from going from this conversation of helping managers build their business and so on, I want to pivot to you and say, you have a great angel experience. You've also got a great VC experience. So tell us a bit about yourself, and also especially on this topic of LP investing.
Yes, indeed. I'm very much less impressive than Michael, but I have a very different journey as well. So I'm an entrepreneur by heart, but VC by choice. Actually started my career as an entrepreneur, built 3 companies. The first one I bootstrapped and sold. The second one I VC financed and bankrupt. The third one I bootstrapped again, and it's profitable and working well. So you might gonna take your own take on how to finance your next company. And for the past decade, I've been a VC, and it kind of felt like an executive MBA in venture capital, which was paid, because I went through all stages. I started very classically as an investment manager. From there, I moved into global venture development. So I kind of internationalized companies between Europe and Middle East, Southeast Asia, and India. And I as well built company building infrastructures around the globe. So I structured them bottom up, literally end to end from a financial, operational, and then legal point of view. And the second part of my career, I've been mainly involved in structuring funds. Here again, end-to-end PPM, LPA, fund model, thesis validation, and portfolio construction on the other side. That was particularly meaningful for me because I kind of built my own little playbook on how to do things in venture capital, do's and don'ts, best and worst practices. And besides that, I'm a very active angel. I have a private portfolio of over 30 companies. I invested in multiple funds as a very important aspect and cornerstone of my angel strategy. And last year, I joined forces with Ingo and Videsha, my partners in crime and Altitude, and we launched a VC fund, which is very particular because we created a certain edge around angels, so a sourcing edge, and we jointly have done over 500 transactions around the globe, mainly in early stage, and we deployed way beyond 100 million in early stage companies.
Very cool.
Believe it or not,
Mark.
that's it. Yes.
No. So the reason was I was just playing around with the live feed here because I'm seeing some people having issues. But thanks a million, Mark. Joachim, would you take the mic then and tell us a bit about your own journey, and also because you've done an LP syndicate into your fund, so I'm curious to also hear your experience there.
Yeah. So my exposure to venture actually happened at the kitchen table. So my father and his business partner, back in the late 70s, got into what we now sort of a mix between VC, PE, leverage buyouts, when things weren't really that particular yet, set up one of the first VCs here in the Netherlands. And basically, no real strategy other than seeking opportunities anywhere on the globe. Started investing in the CIS just after the fall of the wall. Still active in Georgia. So that sort of venture fund turned into more of a family office with a separate arm on real estate, and then an active arm just doing direct participations. But also in the 80s, helped set up a fund in New York, a PE fund, which is still there. So that has been sort of a journey that I've seen from the kitchen table, looking into paperworks in my father's briefcase, which ignited an interest in this space. First started my career in smaller like SME M&A consulting, then started my own company in Austria during the boom of the biofuel craze here in Europe. Raised a lot of money, lost a lot of money because of the subsequent crash in that market. Went into turnarounds during the financial crisis, And then together with my wife, she had a career, I didn't. We ended up in the United States, in Portland, Oregon, where I got sort of like into the Silicon Forest network there of young startups or pre MVP startups, even on the advisory side. And when it became time to go back to the Netherlands, a friend of mine who is a very active angel investor, at that point living in Ukraine and previously in Russia, wanted to build a fund off the back of sort of his exposure to that region. And that's how we joined forces, both having pretty interesting links to the region. And that's how we started Acrobator, which is a venture fund focused on investing in founders originally from countries like Ukraine, Armenia, Georgia, Russia, anywhere there, living anywhere in the world, and investing at pre-seed, seed. And that's also where we met Andreas and David in the process of this fundraising. And they got a syndicate together to back us. I think we have a very broad base of LPs, anything from sovereign wealth fund to fund of funds to big unicorn, decacorn tech founders to DJs out of the Netherlands. That's in a nutshell where we are.
We all know that the majority of the wealth in the Netherlands are in the hands of the DJs. So now, David, let me kick it to you and just introduce yourself to anyone who doesn't know you already, and tell us a bit about the LP syndicates that you are a big part of in the UVC machine.
Yeah, indeed. Guys, super nice to be here. Hi to everyone in the comment thread. Do share questions and so on. I won't spend a lot of time with intros because it's almost like if you're seeing this, you know who we are at UVC. But David here, one of the co-founders, one of the hosts of the European VC podcast, and I'm also the one responsible mostly for leading the syndication operations here at UVC, which leads us beautifully into our LP investing experience. We are, I like to say, we're new bucks to the space. So we've been doing LP investing for 2 years only now. We've invested in a handful of VC funds, all of them European focused, all of them early stage, and if I may say so, all of them fucking awesome, I think. And so just really cool to see Joachim here. Really exciting. Also really cool to be here with Mark. It's very exciting to do stuff with the VCs that we partner with and we believe in. Super exciting. And that's us in a nutshell. So we're doing syndicates. We're focused on deepening the relationships between VCs, super angels, and families. And that's kind of the one-liner of what UVC is doing with its syndicates.
And that brings us into the 5 slides that I promised we will go through quickly. We will be looking at structure, fund lifecycle, fees, and returns. And it's important to say this is in no way an angel investing or LP investing 101 session. It's just to make sure that we all have the same context going into this and we all know somewhat the dynamics of LP investing. The reason why we put angel up there in brackets is that, in fact, the difference between LP investing and angel LP investing, at least if you look at the more families and high net worth individuals doing LP investing, the motivations and the core things that you're looking for aren't all that different. So for that reason, we styled this as angel LP syndicates and the rise of those, but in fact we could have almost just called it LP investing. The only change or difference when we put on the word syndicates is that we're now opening it up so many more can join in by going via syndicates. So that's the only point that's really important to note there. David, you've got 5 slides to take us through, and I'm counting down, and I'll force you to go quick.
Yeah, just want to restate what Andreas said. This is definitely not a masterclass or whatever. It's just very basic concepts to make sure we're aligned. So let's start with structure. Goes without saying, everyone knows that funds invest in firms, and that's what you see on the lower bit of this of this image, you see a fund investing into funds, but we're talking here about LP investing and GP-LP relations. And just to clarify that, there's a GP that is basically the entity, the PE firm or the VC firm in our specific case, that manages that fund. And then we have the investors, the LPs, the limited partners, who have some ownership of that fund based on their investment. So they subscribe to participation units per se, to have their money then deployed by that firm through the fund. Is that quick enough?
It you got for the first one. Fourth slide.
No, fund life cycle. This is a really simple one. As everything, you need to set things up. So there's a formation period that might take very little time, a lot of time. There's a lot of content out there. It doesn't really matter. You need to set up the fund. You need to invest the money you have in the fund. You need to harvest or divest. That means we don't make money by investing. We make money by selling what we've invested in at a higher valuation. And then there's the extension period, which doesn't necessarily mean it's not necessarily a bad thing. There's many reasons why you might extend the fund life cycle. Assets might need more time to mature. There might be interesting opportunities further down the line if you hold a bit. So these extensions varies a lot, but they might go as I don't know, as much as 6 years, but typically 4 years or so. Depends a bit.
Whoa! Now we've got 3 slides left.
This is the part everyone loves. Fees.
It's at least a
No.
topic for many to discuss.
No, it goes without saying that VCs have to pay bills as well. VCs aren't necessarily super wealthy. They manage a lot of money often, but that doesn't mean it's their money. So there's a fee called the management fee. That's how we pay the team. That's how we pay our own salaries. That's basically it. And there's a carry fee. That means the incentive for a VC to do a really good job is that they get a bit of those profits, called carried interest or carry. There's no kind of exact number here of what is the right amount of management fee and carry fee and whatnot, but a good reference is just the standard 220, somewhat of the average benchmark standard, whatever. It's not the right number, it's just a good number to keep in mind. If we talk about syndicates, because it is a topic we're talking about as well, syndicates also have costs. There's the pure cost of doing a syndicate, pooling money together to deploy an investment. And then there might be management and carry fees. It depends. If you're just pooling money with your friends, probably just going to kind of share the cost pro rata all across the different people participating. If you're using some kind of professionalized platform and or team and or boutique consultancy, whatever, then you're likely going to have either management fees and or carry fees, which is again similar to a GP. It's what justifies the people putting in the hours and the work and the effort to do amazing investments with you.
Now you've got 2 slides left. Let's go quick.
Here's the beautiful J curve or the not so beautiful J curve. So this basically explains, there's a period of time where you call the money from your investors as a fund, the money comes into the fund, you start investing, you start deploying the money. It takes some time for that to increase in value. Obviously, there's a kind of this J curve concept because you have to pay out fees. Some companies might go to shit. That happens, unfortunately. But after some time, if the fund is successful, we see some of the assets valuating in a way that we see this J curve in terms of value. And that's why everyone in venture is in it, to see this little beautiful kind of hockey stick effect.
And final slide.
Final slide. A lot of information here. Let's not get lost. Let's look at the third one here, venture capital. This means the returns of VC funds. And the only message here that I would like to share is you can make money, but you can also lose money, right? As we see there. And so picking is important. It's not because someone can raise a fund that they will not lose money. It is risky. Your capital is at risk. And so this, I think, frames beautifully the next topic that Andreas will lead us to, which is, well, I don't want to lose money. So how do I pick funds? Andreas, over to you.
Yeah, I would maybe just say, this is exactly this slide is so baffling to me, and it's exactly why I am so passionate about venture capital fund investing, because it should not be like this. And I hope that with increasing sophistication on the LP side, we can improve the spread that we have in performance there. But let's kill this slideshow, because now we'll go into, so this was the bomb. We are done talking about this. Now we will go into how the panel thinks about picking VCs. And remember, everyone, You just heard all of them styled as VCs. So that means that they are, except for Michael, raising capital for their own funds. So they have that perspective, but they have also all invested into venture funds, both in the capacity of being family offices or angels. So we've got the breadth here of people knowing how to think about this. And I really wanted a panel that could juxtapose from both sides and say, okay, this is how we as VCs think about it, and this is how we as LPs think about it. So the very first question that I want to go into is the question of how do you decide on the funds you want to back? And we just had a question by someone in the chat, or I can show the question here, but I, for some reason, can't see who asked it. He loved it so far, but she asked, do you have a section about due diligence? This is the section where we're going to get into this. Obviously, we will not dive super deep and tell you what's the checklist and so on. We've got resources for that. There's a lot of great resources out there that you can dive into. Subscribe to EU.VC. I'm pretty sure you'll get some learnings from that. But now let me kick the question, and I'll start with you, Michael, because you're very experienced in this space. So how do you think about the funds that you've picked so far? If you know, when you first meet a manager or get a deck in the door, what's the first thing you think?
Yeah, it's a good question. I'll preface this actually by starting one step higher, which is VCs, when they're trying to raise money from LPs, they should think about what their product is and who they're selling to, right? There are some funds that are the right fit for institutional LPs, pensions, endowments. There are some funds that are a right fit for family offices or fund of funds, and there's different reasons why. And I think that ends up being important to some extent when thinking about from the LP side, you know, which funds you end up backing. So as an LP, when I think about what funds to back, from our perspective, we're doing investing in funds for a specific reason, which is to get exposure to the venture ecosystem outside of fintech, which is our expertise in what we do directly. Some of the funds that we invest in also have some exposure to fintech, but we don't need to double up our exposure to fintech. So we're often investing into climate-focused VCs or consumer-focused VCs or different geographies of the world where we don't have that expertise or boots on the ground. So we're doing it for a reason, obviously to generate returns, but also to broaden our aperture and surface area of what we can cover within the venture ecosystem, because we know that there's only a given number of unicorns or you know, $100 million plus revenue businesses that, in terms of potential they have to be that size and scale, that can be built in any given vintage year. So we want to give ourselves as many shots on goal or as much exposure to that as possible. So when I think about investing in VCs, I think that the most important thing from my perspective is what's their edge. So how do they have, and how do I define edge? I think of it as what will be differentiated for them in terms of four categories as a VC: finding, picking, winning, and helping. So, and I generally tend to focus on the finding and picking because those are really the most important things that drive value. Sure, winning is important and helping is important, but often the first two really are what drive value. So I look for what's the edge that a VC has. I think, you know, you look at the successful VCs, there's very different phenotypes of what a successful VC, there's no one answer. You know, Fred Wilson or Bill Gurley were never operators before, yet Union Square Ventures and Benchmark have been incredibly successful funds. Mike Morris from Sequoia was a journalist, great storyteller, but wasn't necessarily an operator either. Then you have the operator investors, the Andreessens, you name it, of the world, where they were operators and are able to win for that reason. And then you have, you know, people who are creating content as ways to win deals. So I think there's so many different ways to have an edge. But for us, when I look at a deck or when I'm talking to a manager, it's what is their differentiation that's going to be very unique. And then I think for us, the other pieces that matter are we believe that sector specialists are the ones who are going to generate outsized returns going forward. I think it's going to be harder for generalists in many cases to produce outsized returns because founders want the specialized VCs. They believe that those are the VCs who can, in the winning and helping category, can win those deals and then help them. And then for us, the other piece, we generally tend to focus on emerging managers, so funds 1 through 3. And we have found that fund size matters, right? So much easier to create a fund returner off if you have a $10 million fund or $20 or $30 million fund than it is off a $500 million fund. Again, different size funds are what drive the strategy you have in terms of ownership, et cetera. But it's certainly easier if you have a $10 million fund. You don't necessarily need to be as ownership sensitive, and you can have a massive winner. We've seen this for investors in a fund called Tiny in Europe. They don't lead, but have written small checks into many European companies. They were early seed investors in Sorare and Payhawk, and a few companies have driven significant returns. So I think those are a few things that we really look for when it comes to what can drive outsized returns. But I think the most important thing to remember is that as a VC, whatever your fund size is, that's the product that you're creating for LPs. And that product may be different for different types of customers. Institutional LPs may have to put $100 million to work. So therefore, if you're a $10 million fund, you're not going to be able to raise capital from an institution. So I think that's also the important piece too. There's no right or wrong on fund size. You just have to know what business you're building. And then as an LP, understand what you're aiming for when it comes to returns and or other things like co-invests, geographic exposure, et cetera, that I'm sure you'll get access to.
Yeah. And now, Mark, I want to kick it over to you because I know that, and this is one of the things that we've had many conversations about, because with Altitude, you're very focused on the angel segment, and you're also very you're self-developed in your mindset around how to invest into venture funds as an angel and leverage those. And I think that Michael touched on exactly the point of fund size and you mattering as the LP to the fund, because if you don't, you're not going to see the strategic, gains that you're looking for when you're investing, because it's one thing to get 3x or 5x or whatever you're hoping for, but it's, as I call it, right, the UX, you're looking to get leverage yourself via your fund investment. So Mark, I'll kick it to you and ask you to just tell us a bit about how you think about that part, the strategic part of doing LP investments.
Yeah, Michael covered it fantastically well, coming from a very institutional, professional way of looking at fund investment as an LP. But there's the other side, how do angels look at it? And I can cover that fantastically well due to the fact that I've done multiple investments in funds. And I have a very particular reason. So first of all, there's lots of reasons why angels might consider investing into a fund directly or throughout the syndicate. It could be access to deal flow, it could be follow-on opportunities, it could be knowledge, it could be particular events or just meeting other LPs and like-minded people. So just broadening their network in general. For me, it's always been, I always invested into funds which were not in my geography. So I know my home turf, I know where I have great access, I know where I see great deals. So I always focused on markets which I just don't have this kind of access. But still, I believe either in the geography, a good example is Latin America, started to do LP investments 2015. Back then, there was literally nothing. The market was about to take off, and I just had the feeling, hey, this is going to be great. Everybody had kind of this gold digger mood. And I started investing there because I simply didn't have access. Going directly was just too hard. So having fund access was the way to go for me. The second thing, which was very meaningful for me, is investing into funds, doing things I can't do because I don't understand them. A very good example is I invested into Nucleus Capital as an LP. I have absolutely no idea. Well, I do understand the things they do, but I don't have the access. I'm not that specialized, and I would not create this kind of particular stellar deal flow they can do. So for me, it's a way of learning, it's a way of access, it's a way of network, and of course, kind of transferring everything I see there into what I'm doing on a daily basis. So I think the motivation from an angel is a complete different one, aside of course, everybody wants to make money, great returns. So I totally check on that. Looking at angels from our point of view, and I think Michael touched that point already earlier, for us, it's about sourcing. Everything is about sourcing. So creating better access earlier, that's our main motivation. So we thought about how can we engage with angels and how can we see unbiased deal flow from informal sources. So looking at yourself as an angel is, hey, you always invest with the same peers. So you're kind of in a small bubble. And we thought we want to actually get out of this bubble and touch other informal markets to get access of this kind of unbiased deal flow of people we don't know. And for us, it's not a one-way street. It's actually a two-way street because we want to invest with other angels we don't know. We give them up to 100K. We co-invest with them. We give them the full carry upside to have like an economic alignment with them. But moreover, we actually want to engage with angels we don't know to drag them into deals we do. Why? Because every angel usually has a superpower. They have network, they have a domain expertise, they have lots of things they can bring to the table, which in some cases are even more valuable than most VCs can bring. And we think that we can enrich cap tables by bringing exactly these people to the table. So we're kind of touching the points of, hey, we give you the opportunity to invest with us, and I will give you the opportunity to see what we do as a deal flow. So you can jointly invest with us, and we can actually create mutual synergies. So just to summarize it, I think it's a matter of like how much money do you have, whether you can go direct or whether you go through a syndicate, and it's a matter of what's your overall strategy as an angel, how you want to invest. And I think each and every angel should have LP investments as a bottom line of what they do. Angel investing is super risky, so you kind of can take part of the risk out by having some LP investments where you see different opportunities, where you engage with other people, and then kind of de-risk your portfolio per se. And I think there's multiple other points and reasons why you could do it. And one very last point, I fully agree with Michael, size matters. In all terms when it comes to venture capital. I mean, looking at very big funds at a $300, $400, $500 million fund, they have to address very big companies with a very big TAM in order to have a terminal value which is relevant enough to return their fund. Now look at a 10 million fund. They can do 30 investments, hit one outlier, return the full fund. And they don't need to sell a company for 4 billion. They can sell a company for 500 million and return the fund. So they kind of don't depend on these massive outliers, which you actually have 1 in 10,000. They can be very good pickers in smaller industries with a smaller total addressable market and analog smaller terminal value, and still be hyper successful and outperform their peers or vintages with bigger funds. And I think this is something very important to understand.
Yeah, and I think I just want to come in very quickly and before kicking it to Joachim, where I've just asked him if on the chat if he would talk a bit about how he thinks about picking angels as a VC, because that's also what a VC does when they choose to say, okay, I do want this angel into my fund, whether it be as a direct investor or via a syndicate. There's typically limited room there, and it's people that you have to manage each of them. So you don't just get you don't just get access automatically. It's the same thing as a startup. You do have to have an edge typically, especially if you're putting smaller tickets. Of course, if you're putting a €5 million ticket, most VCs won't ask too many questions. But if you're asking, can I come in with 100K or can I come in via this syndicate or something like that, then you'll see more questions being asked, or at least them making sure that you are a value add player and you're not there to just siphon off deal flow and get some insights and that type of thing. But I would just add, Mark, to your part, I think it's incredibly interesting to see how many angels have never done fund investments. And I hope that it's something that we will see changing drastically in Europe, whether it be with us or directly or them starting to syndicate more together to do it. I don't care, but I really think that there's a lot of best practice that can be spread more efficiently in the ecosystem if we have a better connection between the VCs and the angels. But Joachim, now let me kick it to you and ask you to enlighten us a bit on how you think about then picking angels for your venture fund.
Sure. Maybe before going there, I think what Michael said is also important to look at from the other side. Like as a VC, you should see yourself as a product and a reason to exist. If you can't define that, then don't start a VC, right? You need to have an edge. You have to have sort of the way we put it when we started is like, we weren't focused on getting like smaller ticket investors on board, because you can't design a fund or a strategy around that. You need to focus on like, okay, what are like the largest, most professional investors that I could potentially get into this fund, and why would they invest? And it's like you have to see it as a box that isn't ticked, like Michael said. Like, I need access to this geo, I don't have it. So that's how we sort of thought about the fund, and then on the due diligence side, everything that goes with it. If we want to target these very professional investors, then how do we look from the inside?
Yeah, could I just double tap on that thing there, because I would really challenge every angel listening in to ask themselves, even for their own vertical, are they seeing the very best deals in their vertical and geo? And if they can see, I'm actually maybe not, then my very quickest response would be then build your way towards them. And I always say, well, it's almost, you should think of venture as high school. If you want to get to the blonde over there, the big bulky blonde, of course, because I'm not being a chauvinist here. So the big bulky blonde quarterback guy, if you want to get to him, then you need to just really work strategically your way there. And you do that by that person's friends. And you do the exact same thing in venture. It's very, very simple. Just think about the high school dynamics. And doing a fun ticket is just like saying, I'll buy you dinner. So it's pretty simple, really. And I really think that most angels, if they are asking themselves very, very honestly, am I seeing the very best deals coming out of Copenhagen? Or do they tend to go to buy founders or another fund before me? Then I'd really say start thinking about doing fund investments. It's definitely one way to get there quite quickly because you can skip some queues. But Joachim, I'll go back to you. Sorry for talking about high school and big bulky blondes here.
Regarding the specific question on angels in funds, so there are a couple of sort of limitations usually that funds have to deal with, which have to do with regulation. We're structured in the Netherlands. Netherlands has a rule that you're only considered to be a professional investor if you're a bank, a pension fund, or a large institution, or someone that can fork over 100K in one go. Meaning, if you want to invest 50K in my fund, I'm not allowed to accept it. Another reason for funds not to, accept smaller tickets usually is administrative hurdles, right? Now we have, by design, said we want to be a fund that will never in our life have a lower limit on what you can invest, bar from whatever regulations prescribe. But in order to do that, everything we do is designed to be as automated or as efficient, SaaS-based as possible, so we don't have at least laziness as a burden. When it comes to talking to angel LPs, the first thing I'm usually concerned about is their level of understanding of what venture is, the risk appetite they have. I dare even to go into the question of this ticket that you're considering, how much of your freely disposable assets is this? Like, if I'm not sure who they are, because the last thing I would want is someone to get like, oh, I'm going to put 100K out of my 500K that I have at my disposal into your fund. That is just not what you should be doing. So that's something we're very wary about. And we have said no to some angels because of that. And
on that note, Joachim, I remember our first meetup with the syndicate with you guys, and I remember one of our syndicate investors said, "Well, I'm like, my mindset going into this is exactly as you described. I've invested this money. I'm super optimistic. I really want this to work out, but I am comfortable if this goes to shit." And I remember your reaction to that, saying, "Well, that is a really good thing to hear, because obviously we're all here for the upside, but yes, capital is at risk." I just wanted to double click on that because I saw that in action in a meeting with you and a bunch of angels.
Yeah, it's the one thing is like, can you sleep if I tell you this money is gone? Basically. And also to the understanding, and then just also clicking on a comment here in the chat about returning 100x versus 10x. From our perspective, like, I cannot invest saying, I think this risk is lower, therefore my expectation is fine if it's only a 10x. We're investing in pre-seed seed. The risk is enormous. So from our point of view, everything we invest in has to, on its own, be able to return the fund, and not assuming like, oh, this sounds less risky and therefore, it's okay if we can't design a fund around that. So I think that's very important. I think if you would be able to, it would be very interesting if you have a level of domain expertise in a certain niche that allows you to really say, this is what I invest in, and I know the return expectations are lower, but I also can really limit the downside. That's a different story. So when we're engaging with angels into our fund, like that is a thing. Like, do they understand what we are doing? That's very important. And then from the side, like, we are extremely interested to know their backgrounds, because for us, and I'll tell you also straight, we're not there yet, but we now have 68 LPs in our fund by design. The largest has 15%, the smallest have like very small tickets. That is a network that is engaged with you, that has an interest that you do well. Therefore, it's a network that we can leverage from validation, which we do most. Like, we have so many different sort of quote unquote experts in our fund through our LPs that when we want to validate deals, there's no issue reaching out to them, and they will put their best leg forward or introduce us to whomever they think is excellent at validating that deal. So we see a very high synergetic effect, and for us it doesn't matter what the ticket size is. We also don't have any, for instance, preferential treatment. We have a sovereign wealth fund on board. They are used to getting everything they want. They have exactly the same rights as someone that did 100K in our fund. There is no difference, and that's by design, because we believe that there should be a very equalized structure.
Yeah. And I think that here in the end, you touched on the next thing that I wanted to get into, which is how to get the most out of your VCs. Because as you said, Joachim, as a VC, you of course have an LP base behind you that you're leveraging, but the LP base is also there to leverage you. That's why I always talk about UX and not 3X. It's about leveraging yourself and what you have around you. So guys, I would love to ask you, how does an angel best get the most out of their VC relationships? And Michael, I'll ask you to go first here.
Yeah, so I think the first thing, it again depends on what the angel or individual LP's goal is, but I think first is returns. At the end of the day, there's only a finite amount of capital, and you want to be allocated to the top funds. And I think I love this slide that you had on dispersion of returns between first and fourth quartile funds, and in venture that matters more than others, right? The interquartile dispersion is so great. And I think the first point I'll make on this is that in many respects, while it's great to invest directly as an individual or angel into companies, the question of, are you seeing better deal flow than the funds, is a really important question. That's one we ask ourselves, and that's why we're investing in climate-focused VCs or consumer-focused VCs or VCs, micro VCs in Africa or Europe, because they will likely see better deals than we will in those cases. And I think that's how you're going to drive returns. And you can make an argument too, and while we believe in the democratization or unlocking access to private markets writ large in terms of people investing at lower minimums directly into companies, you can make an argument that from a risk-adjusted basis, it's better for people to invest into funds, because those managers are spending every day in their field or geography, have an expertise. They're going to likely find better deal flow than many individuals or angels will as well. Doesn't mean that people shouldn't do that too. There may be different reasons for investing directly into companies, but funds can be a great way for people to generate returns if you're investing in the right managers. The key is, how do you get access to the top managers? And now I think we touched on this as well, the innovation, like Joachim mentioned, in terms of the infrastructure, the companies, the iCapitals, the Valbonds, the Bunches, the Moonfares, et cetera, of the world that are providing access to high quality investment funds is important. What you all are doing at EUVC as well, and leveraging some of the tech to do that. I think that's a huge unlock in this space, and that's different than it was before, and why people are now able to invest in funds just like they were able to invest into companies. But I think that's the first thing, is how do you drive returns? Because at the end of the day, you want to be able to recycle that capital and continue to put it into innovation, whether it's directly or into other funds. The other two things I think that at least we find are really important when we think about investing into funds is, how do we have a better understanding of a market or a space? We've done this directly as well. I didn't expect to lead a seed round into a digital freight forwarding business in Latin America, a company called Nowports, which we led the seed round and has now had about 250 or so million of successive capital invested into it. But there's an embedded finance play, so we invested in that space, and now we've done more in kind of the outside and embedded finance play. So I think in the same way that when we're investing directly into fintech companies, you invest in one company and then you learn about that ecosystem and space. I think you can do the same with funds as well. Investing in funds in certain sectors or strategies or categories helps you understand a space better. You get educated, and then maybe you become a more prepared mind when you do see companies directly as an angel in a certain space, climate, whatever it may be, right? So I think that's another important piece. And related to that, co-investments can be a great way to blend down the total fee load that you're paying. Sometimes managers will offer co-invests at lower fees or fee-free in certain cases. So that gives investors the ability to blend down their fees. And related to the last point, learn about a specific space because they're more directly involved with the company. And maybe this is where funds can really leverage their individual LP base or their angels in their LP syndicate. There may be certain LPs who have expertise in a specific space, and then bringing that LP to the table in a co-investment situation can be fantastic for the company and also may help them win an allocation or get an outsized allocation. So I think there's a lot of synergies on both sides of the table for GPs and LPs from thinking about what are the different ways in which you can really leverage some of that expertise that you have in your community.
Yeah, absolutely. And I think you had a core word there, community, which pivots me perfectly over to David, because everything we're doing is community building. So David, please take the floor on this question, how to get the most out of your VCs.
Well, I like how Michael framed it, because it all comes down to why, right? Why did you start off by investing, right? And what we see in our community of angels and families is we see 3 to 4 reasons kind of permeating it all the time, which we've covered already. It's long-term returns. Notice long-term. It's diversification. It's learning, exposure to venture, exposure to emerging technologies, exposure to industry developments, whatever that is, but it's learning. And then 4th, co-invests. It's actually not the one we see the most, funny enough, but we see a lot the learning one permeating every single investment that our angels are doing and families are doing with us. And that's why us at UVC, we have some kind of, obviously we try to do the best ED we can and as sophisticated as we can. We have some really important criteria for us aside from that. And I like to call it the partnership fit and the community fit. And the partnership fit is basically, do I see myself working with this team for the coming 10, 12, 14, 15 years, right? Because that's part of it. Because if I invest expecting to learn from Joachim, well, he needs to want to partake in that, joint exercise, or if not, it's just going to be a failed experiment from the get-go, right? And so that's one. And then community fit is obviously, we're also trying to build kind of a community, not only on the kind of angels investing into VC funds, angels and families investing into VC funds, but also among the VC funds, right? There's a lot of synergies there. So that's basically, the better we do our job in picking, the more natural this value creation comes out of it, right? Because I always say, like, I'm trying to build Europe's leading platform for GP-LP relations, right? That's it. And so if I pick right, I just need my GPs to do their job and to kick ass, right? And I just need to get out of the way, and things will naturally happen. And that vested interest between the parties will naturally happen. But that's why I think like picking is so important. And that's also why I think it's so important as an angel to really think about, okay, why am I doing this? And then second, should I do it myself? Meaning, should I invest direct if I can't afford it? If I can't afford it, should I be leading the syndicates and picking? Or should I try and partner with people who can do it for me, the same way a fund of fund operates, right? So that's really where I think angels should spend the time of understanding. And it might be different for each deal. So I might be a US angel that really understands the US ecosystem and I really know who's who, but maybe in Europe, Asia, Africa, whatever, it's a bit of a question mark, right? So I think that's really important to highlight, because then the value add just comes naturally out of it.
Could I ask you all? Could I ask you all how do you think about SVCs engaging with your LP base, and if an LP comes in, what type of engagement can they expect from you? Meaning, will they have a WhatsApp with you that they can just kind of hit you up on with whatever time, or should they expect a quarterly report and then maybe you can also meet every quarter or you can meet every year? And is that contingent on ticket size? How do you think about that? And how would you? And I'm of course asking this because it's also on the very practical level that we'll have angels listening in here thinking, what can I really expect when I go into a relationship with a VC?
Very happy to pick up that question because I wanted to touch down on what has been said. I think the GP-LP relationship is a very difficult one per se, because it's a lot about expectation management. So depending on whether you're a high net individual, a family office, a fund of fund, institutional, you might have different like purposes or like means why you will invest into funds. And one is the expectation what you're going to get out of it aside of a financial return, and the other one is what the GP is going to deliver at the end of the day. So before investing into a fund, you should be really sure that you will get exactly what you're looking for aside of financial returns. So if you speak to a GP and he tells you, I'm going to share all my deal flow with you, you can invest with alongside with me, the very honest truth is this will not be the case in all times. So there's some LPs which have side letters, which have preferential rights, which have first dips whatsoever. That's one thing. The other one is if you don't maintain a good relationship with the GP, you're going to have a hard time to get co-investment opportunities. You might maybe even have hard times to get invited to events, which they actually do. So I think aside of money, every LP is bringing this to the table. You have to bring a special power. At least that's my philosophy. If you bring a special power, you're more relevant for a GP. So you can be a tiny LP, which is very irrelevant looking at all the others putting millions into that fund. But if you have a very particular, highly relevant network for your portfolio, believe me, that GP will call you every week. He will ask you for introduction. He will ask you to be engaged. He will invite you. He will give you what you want. And at the end of the day, co-investment opportunities are at the discretion of the GP. So if I want to give them to you and grant them to you, I will give them to you. Unless, of course, I have other restrictions due to a side letter. So I think it's very important to kind of match your expectations with reality and don't just jump on any kind of fund because GPs promise you the world and tell you, hey, this is going to be great and awesome, going to A, make you richer, and B, you're going to, get access to my whole network. And I think it's very relevant to have a sanity check and kind of understand. And the best way to do it is reference checks. Call other LPs, call people who work with this guy. Is what they sell to you actually what you're going to receive at the end of the day? So I think due diligence is not a one-way street. You have to do both. And me as a GP, I do the same thing. I try to understand who I'm going to be on this journey with. And if I hear 10 negative things about a certain LP bugging me all the time and like being like very negative, then maybe it's not the right LP. And vice versa, you as LP, you have to do your homework to understand whether this is the right GP or manager which you want to kind of pass your money to. Don't want to be negative.
Now we've gone through how your VC can help you, and as you just heard from Mark, if you bring the right thing to your VC, the VC that you've invested in, they will be calling you at every moment of the day to try and keep you engaged and keep sending them great deals. But I would love to ask the same question to you, Joachim. How to help your VCs as an LP. You come with a family office background as well before you founded Acrobat Ventures. So you're very used to being in that situation where you want to look, you want to get as good an approach to your VCs as possible. And you know that you don't get that only by wiring the money.
Yeah, so I think, as a VC, I'm always interested, like, how are we doing? And especially, how are we doing compared to others? And that goes of everything. Like, how does our reporting, or what we write in our reporting, stack up? So feedback loops are great, even if it's just an email. And then, as an angel, you see what we invest in. Therefore, if you have an affinity with that sector, that company, we are always, we're very easy to reach, whether that's WhatsApp, email, call, anytime. When it comes to co-investments, we've done it by design that everybody has a pro rata right for co-investments. Even if they skip a round, they can still go into the next round, bar some dilution through the fund. But so we at least seek to have a very open door. The reality, though, is that most LPs don't actually interact.
Use it, yeah.
Yeah.
Could I pick up on something that you said? Because you said we're very easy to reach, we're very accessible.
Mm-hmm.
Every VC says that, and I find it to be very, very true. Mm-hmm. I am myself very accessible as well. But I also have come to be in a position where if I actually said yes to every meeting that I was being requested, or even replied with anything but a five-word answer to many of those outreaches, I would not be able to do my job because I'd be sitting there replying to stuff all day long.
Sure.
And for that reason, I would say to everyone listening in, because I know that many angels say VCs say that they're so accessible, but in reality, fuck no. I've written to 5 and I've practically never heard back from them, or I got a one-line answer which was a decline, right? And I think that there's an important dynamic there, that is to say, life is a two-way street, right? You give and you take. And most VCs are in positions where a lot of people are trying to take, but when they're fundraising, as an example, not that many are very busy giving. And for that reason, if you really want to build a relationship with Mark's Altitude or Joachim's Acrobatter or Tiny's fund, then by being there when they're fundraising and saying, I do want to put a ticket, what's your minimum? Is there a syndicate that I can join in? Then you've actually shown and earned your right to get a decent reply when you send something. And if it's a deal and you're an LP, you're still going to be declined if that deal is not for the fund, obviously. But you're probably going to get a more thorough decline, or maybe a quick decline, and then say, happy to jump on a call if you'd love to understand more. So I think that there's that give and take relationship to everything in life that I think too many don't understand the importance of being on the right side of when it comes to engaging with venture capitalists. Did I say anything that provoked anyone here, or are you in agreement? Michael, come on.
No, in agreement. And I think if you break down, kind of what you're saying, if you take the word limited partner, I think people may have thought that means more limited and means like having a more passive relationship with the GP who's doing a lot of the work. But I think when you think about it, and maybe this is changing with the times as well, as more people are able to get involved in VC funds and add value in different ways. But I think it's helpful as an LP to think about fund managers as founders. They're running a business. It just happens to be an asset management business. But if you break down the way in which fund managers make money, there was a slide that showed 2 and 20 or whatever the fee streams may be. But the management fees are for one customer, the LP, and the performance fees are related to another customer, the founder, right? Because that they invest, and then when those companies do well, they obviously take the fees from the LP. But there's 2 customers in a VC's business. And in order to have the right to invest, you have to raise money. And I think that's where, to the extent that people are able to help, that ends up being a really important way for LPs to engage. LPs may have networks. They may have other people who want to invest in funds as well. And if those LPs can introduce GPs to capital through other LP relationships or putting them in places where they can then raise additional capital, that can be a very valuable tool, I think. And we're seeing this more and more as there's the rise in micromanagers or emerging managers who may be very talented in one way, shape, or form as an operator or a former VC who are now breaking off from a bigger platform. But many of those smaller funds don't have the LP relationships. So what they really need to get their business going is access to capital. And again, we've talked about that there are a number of ways that can happen. But if you think about fund managers as founders, that first customer base is so important, and being able to help them ends up being a really important piece. And then on the flip side, once they've raised the capital, to be able to introduce VCs to other companies, whether or not it's a fit, VCs generally won't turn down deal flow. And to that point, it just keeps the VC, just like a VC helps founders. They don't have to be the largest VCs. And sometimes, it's not the largest VC on the cap table that's the one who's most engaged or active with founders. But when those VCs are active and engaged with founders, when the next round comes around, even if there's not room for pro rata, that VC is going to be top of mind. And I think the same goes for LPs with fund managers when it comes to things like co-invest. Even if they're not the biggest, but they helped, they'll be top of mind, and maybe the VC will want to give access to a co-invest or access to a deal that they couldn't do because it's too early. So I think a lot of the same dynamics and concepts apply from a VC to a founder as does an LP to a GP.
Yeah.
Maybe
I
just to pick up.
So I brought up this question exactly because it came from one in the audience, and it goes directly to what you were talking about, right? Mark, I'll let you have the final word. I'm looking at a counter that says we have 30 seconds and 2 seconds until
you just increased the pressure. So maybe for me, like in my perfect world, LPs are kind of satellites. Every satellite has a different function. And some bring network, other bring money or knowledge, domain expertise. There's lots of things you can bring to the table which have an equal or higher value than the money you bring to the table. And you, as a satellite, you have to define what the other extra value or superpower is. And for us, that's the most important thing when we look at LPs. Will we say no to 1 million check? No, if they bring nothing to the table. But if we would have to decide between somebody who's bringing 1 million and somebody who's bringing 1 million and a fantastic network, which is highly relevant for us, well, it's very obvious which way you are going to pick. And this is something you have to be very clear about before you invest into a fund, if you want to get access to other things beside of financial returns.
Exactly. All right, gentlemen, thanks so much for joining us. Everyone listening in, you are amazing. Thank you. We would not be here if it wasn't for your support. So do join us in your GPLP community on EU.vc. As you see in our logo, EU.vc, that's our website. We are fans of having a big blue dot there. To make you understand, of course, you should head on over to our website every time you see that logo and share our content. Thank you, everyone, for participating, for being active in the chat, and for always being there for the European Venture Scene.